In 48 hours, the precious metals market did something it almost never does in public. It showed you the plumbing. Gold didn't drift lower. It fell through levels that days earlier were being treated like a new floor. On February 2nd, 2026, it traded near $4,165 an ounce at the worst point of the day, down as much as 8% in a single session. Silver didn't merely follow. It arrived already bruised, coming off a roughly 30% plunge the prior Friday and then slipping again as the new week opened. Moves like that are not the signature of ordinary disagreement. They're the signature of forced behavior. The kind that happens when leverage meets a sudden change in the rules of engagement. The kind that happens when the people who finance risk decide, abruptly, that risk has become more expensive. And here's the uncomfortable part. By the time most people see the headline, the critical decisions have already been made. The institutions that live inside the system don't wait for explanations. They react to margin schedules, liquidity gaps, inventory optics, and the calendar of passive flows. When those pieces line up, price becomes a consequence, not a cause. What I'm about to lay out isn't a rumor, and it isn't a vibe. It's a pattern. It's a mechanical sequence that has repeated across decades, across different metals and across different regimes. The numbers change, the actors rotate, the language gets updated, but the playbook remains recognizable. Welcome to Signal and Structure, where we decode what markets are doing before the narrative catches up. If you've been here a while, you already know the premise. The biggest moves don't start with a story, they start with a constraint. If you're new, consider this your orientation. And if this kind of breakdown helps, subscribing is like keeping that calm explainer in your feed for the next confusing week. Also, drop a comment with where you're watching from, because it's always revealing to see how different regions experience the same market shock at the same time. Now let's reconstruct what happened, because the details matter. It behaved like a deleveraging event. In the days leading into February 2, prices had already been volatile, which is important because volatility is the ingredient that justifies tighter collateral requirements. Volatility also changes how dealers quote and how much size can move without a cascade. Then the market hit a window where positioning tends to be crowded and liquidity can thin, a mix of post-roll adjustments, risk limits resetting, and the aftershocks of earlier flow shocks that left the market less resilient than it looked on the surface. When price begins to slide in that environment, it does something specific. It triggers stops. Stops trigger market orders. Market orders push price further. That pushes volatility higher. Higher volatility increases the perceived risk of holding leveraged positions. And that's when margin becomes the central character. The reports around that Monday pointed to higher margin requirements on key precious metals futures at the CME. The headline figures being circulated were simple. Gold margin referenced as moving from around 6% of notional value toward 8%, and silver from roughly 11% toward 15%. Those percentages sound modest until you translate them into the reality of a leveraged book. Futures are designed so that a relatively small amount of collateral controls a large amount of exposure. When the collateral requirement jumps, the same exposure suddenly requires more cash. Where does that capital come from? Sometimes from cash on hand, often from selling. And selling in that moment isn't a thesis, it's a necessity. This is where the central mystery appears. If the world suddenly had too much gold and silver, you'd expect the physical side to look loose. You'd expect vault holdings to drain. You'd expect delivery pressure to ease. But the physical picture and the paper price action have been telling different stories for a long time, and that gap becomes loudest during stress events like this. To understand that gap, you have to look at the scoreboard most people ignore: warehouse categories and delivery mechanics. Eligible metal sits in approved warehouses and meets specifications, but it isn't designated for delivery against futures unless the owner chooses to register it. Registered is the portion already tagged and available for delivery, meaning the warehouse has issued the necessary receipts and it can be used to settle a contract without asking the owner for an extra decision. 0.04 troy ounces when you combine categories. 392 troy ounces. Those are not tiny numbers. They tell you metal exists in the system. In calm times, that distinction feels academic. In stress, it becomes the fulcrum of trust. Now zoom out another layer, the London Vault ecosystem. By the end of December 2025, London Vault data showed about 9,106 tons of gold and 918 tons of silver held in London's clearing network. Again, that doesn't prove tightness or looseness by itself, but it does tell you the physical complex is not a desert. There is metal. The question is the terms on which it moves and who is willing to part with it at which price. So if inventories are not screaming empty, why does price behave like a trapdoor? Because in modern precious metals, the price you see can become the price of leverage, not the price of the object. That's not a cynical line. It's the core mechanism. Futures are built for efficiency. Efficiency means you can control large notional exposure with a fraction of the capital that attracts hedgers, speculators, arbitrage desks, and passive products. Over time, it also attracts strategies that depend on stable correlations, stable liquidity, and stable financing. When financing changes, strategies unwind. And this is not the first time we've watched this movie. In 1980, silver became the symbol of a mania. The story is remembered as a dramatic squeeze and a dramatic collapse. What gets lost is how administrative changes can end a crowded move. As volatility rose, margin requirements rose. The rule change didn't need a moral argument, it needed math. When margins jump, the same position requires more capital. If you don't have that capital, you reduce. Reduction happens at the best bid available, not at a thoughtful price. The result is a collapse that can look like a sudden change in belief, when it is, at least at the start, a sudden change in collateral rules. In 2011, silver ran again, fueled by inflation fears, momentum, and a wave of participation that treated the move as inevitable. Then came a rapid series of margin increases. The move didn't need a villain, it needed arithmetic. The market fell in a cascade as leveraged holders de-risked. It felt sudden because the rules changed faster than the public could process. In 2013, gold delivered a different version of the same lesson. The market broke sharply in a short window, and only afterward did the narratives compete, shifting expectations, fund flows, central bank talk, and macro commentary. But the damage was done in the order book first. Explanations arrived later, neatly packaged to fit a move that had already happened. And in 2020, during the March liquidity shock, the world learned that even safe assets can gap when financing and liquidity collide. Gold, for a moment, traded like a stressed asset because dealers were scrambling for dollars and balance sheet capacity, not because gold's identity disappeared overnight. In 2026, the pattern rhymes again, not because history repeats perfectly, but because structure repeats. Now let's name the players, because the market is too vague to be useful. There's the exchange complex where contracts trade and margins are set. There are clearinghouses that guarantee performance and therefore obsess over collateral. There are bullion banks and dealer desks that intermediate between physical and paper, between London and New York, between spot and futures. There are systematic funds that run rules-based strategies, some trend following, some volatility targeting. There are passive index products whose mandate is to hold exposures based on methodology, not discretion. And there are the end users and producers, whose physical needs and hedging decisions often move on a slower clock than the screen does. When volatility spikes, clearinghouses are not thinking about anyone's thesis. They are thinking about settlement risk. Their job is to prevent a chain of defaults. So they raise margin. They may also adjust how margin is calculated, leaning more heavily on percentage of notional exposure when the environment becomes unstable. That sounds like a technical tweak. In practice, it can force leverage out of the system quickly. At the same time, the calendar can deliver its own punch. Passive index rebalancing is one of those forces that sounds boring until you see the scale. $6 billion in gold between January 8 and January 15. Imagine billions of dollars of planned selling pressing into markets that on certain days cannot absorb large size without moving sharply. These flows don't care about anyone's story. They care about tracking error. If the index methodology says reduce this weight, they reduce it. If the product must track, it tracks. That's how you get selling that looks irrational in the moment, but is perfectly rational in a spreadsheet. Now combine that with margin hikes. A passive seller pushes price down. Lower price increases realized and implied volatility. Higher volatility increases margin demands and reduces risk limits. Higher margin forces leveraged holders to reduce. Forced reduction pushes price down further. That's the loop. Once it starts, you can get a 2-day move that feels like a regime change. Here's the part that changes how you read the tape. A loop like this can overpower the usual signals, at least temporarily. It can make a market look like it is repricing fundamentals when it is, in fact, repricing financing. Forced flows don't ask permission from intuition. So where's the dislocation? It sits at the intersection of paper speed and physical friction. On one side, the paper market prints a dramatic collapse. Futures prices drop fast, options implied volatility jumps, and the order book behaves like a flood. On the other side, the physical system still shows substantial holdings in vaults, and the categories that matter for delivery still exist. The logistics of moving metal across borders, across refineries, across specifications does not become frictionless because a screen price moved. A bar in one ecosystem is not always a bar in another. The cost and time to convert, ship, insure, and clear become part of the real price. That's why, during sharp paper moves, you often see the physical world adjust more slowly. Sometimes it shows up as premiums in certain forms. Sometimes it shows up as the difference between what a futures quote implies and what an end user can actually source without delay. Sometimes it shows up as reclassification, where metal moves between eligible and registered as owners decide whether they want to make it available for delivery. Another layer makes the move feel abrupt. The bridge between paper and physical is built on credit. Textbooks say any gap between futures and physical should be arbitraged away. In practice, that arbitrage needs financing lines, warehouse space, insurance, and the ability to carry metal while you wait for settlement. When volatility surges and margins rise, the same dealers that normally smooth differences become defensive. They quote wider spreads, allocate less balance sheet, and demand more compensation for warehousing risk. The bridge narrows right when everyone wants to cross it, so the gap can last longer. That's why registered versus eligible matters. Eligible metal can be abundant, but it still belongs to someone who may not want to convert it into deliverable status during a storm. Conversion can change fees, timing, and obligations, and it forces a decision about making metal, available when price discovery is chaotic. Registered metal, by contrast, already has the paperwork to settle a futures contract. Owners can reclassify metal, but they do it when terms make sense, not when the screen is panicking. Paper can fall fast, while physical holders simply pause. In those moments, watch the basis, the difference between spot quotes and futures, and watch how dealers are willing to finance that spread. If financing dries up, even a small dislocation can widen fast. That's when price stops being a signal and becomes a stress test. This is not about drama, it's about constraints. Dislocations are the market's way of revealing where the constraints are tightest. Let me connect the dots without hand-waving. Start with the stress numbers. Gold traded down to around $4,265 on February 2nd, 2026, down as much as 8% on the day. Silver compounded an already violent Friday decline with a Monday slide. Those aren't routine moves. Then add the collateral shock. Gold margin referenced moving from about 6% to 8% of notional, and silver from roughly 11 to 15. That's a material change in the cost of holding the same exposure. Now add the inventory optics. 625 million total ounces in the COMEX system. 698 million total ounces total. They explain how paper can trade violently without an immediate physical clearing response. Then add the London backdrop. End of December 2025. London Vault holdings were reported around 9,106 tons of gold and 27,818 tons of silver. Metal is present. The question is mobilization. In stress, holders become more selective, they demand better terms, or they choose not to move at all. That selectivity can widen the gap between what futures imply and what physical participants experience. Finally, add the calendar of passive flows. Billions slated for selling over a narrow January window can leave a market with less resilience. Even if those flows are not the only factor, they can set the stage. They can thin the buyer base. They can shift positioning. They can make the next shock more consequential. When you stack these facts, you don't get a conspiracy. You get a mechanism. Now, how does a mechanism like this actually unfold, step by step? Think of leverage like driving fast on a road where the speed limit can change without warning. Futures let you drive at high speed using the fuel of collateral. Margin is the minimum fuel requirement. When the requirement rises, you either bring more fuel or you slow down. If you cannot bring more fuel, you must reduce speed immediately. A leveraged holder wakes up to a margin increase. The clearing process demands more collateral. If the holder is a fund, that collateral might require cash that is not sitting idle. If the holder is a dealer, that collateral might require balance sheet allocation that is suddenly scarce. So they sell. Selling pushes price lower. Lower price increases volatility. Higher volatility increases the next round of margin and risk constraints. And when multiple participants face the same logic at the same time, the market becomes a feedback machine. Options can add another layer. When implied volatility rises, options market makers hedge dynamically. Depending on positioning, that hedging can require selling into weakness or buying into strength. In a violent move, the hedging flows can accelerate the direction of travel, especially when liquidity is thin. And then there's psychology, which arrives after the mechanics have already done damage. Once price breaks key levels, participants who were comfortable become defensive. Funds face redemptions, risk committees tighten limits. The move becomes self-reinforcing. That is how a mechanical shock can turn into a broader loss of confidence. This is why a crash can begin as math and end as emotion. So what does this mean from here, without pretending anyone can script the future? Historically, when a leveraged unwind hits precious metals, the aftermath rarely resolves in a straight line. You tend to see a sequence. First, the air pocket. Then, the reflex bounce. Then, the credibility test. The reflex bounce happens because forced sellers finish selling and price snaps back in a vacuum. The credibility test happens because the market then asks, was the move purely mechanical, or did it reveal something deeper about demand, supply, and the willingness of institutions to finance risk? There are several paths markets have taken after similar events. In a conservative path, volatility remains high for a time but stabilizes. Margins stay higher, leverage stays lower, and price forms a choppy base while physical demand, hedging, and two-way trading reassert themselves. Dislocations narrow. The market rebuilds confidence slowly, and the next big move becomes less about panic and more about balance. In a moderate path, the initial drop triggers stress in linked areas: miners, leveraged products, option structures, and cross-asset portfolios that have to cut risk. In that world, you get repeated liquidity gaps, sharp rallies followed by sharp drops, and a prolonged period where narratives change weekly, but the structural forces remain dominant. In a more aggressive path, the dislocation between paper speed and physical friction becomes harder to ignore. If physical premiums rise while futures remain pressured, or if delivery behavior changes unusually, confidence in the screen price can be tested. Historically, when confidence is tested, the market demands higher compensation for providing liquidity. That can mean wider spreads, higher volatility, and a more unstable equilibrium until a new balance is found. Notice the language. It's conditional. Markets don't offer guarantees. They offer tendencies. If the same inputs persist, the same kinds of behaviors tend to follow. So what should be watched specifically as indicators rather than predictions? Watch margin schedules and any further changes in collateral methodology. Watch whether implied volatility stays elevated or collapses. Watch the spread between delivery months because it can reflect stress in financing. Watch inventory reporting and, more importantly, changes in registered versus eligible categories because those shifts can signal whether holders are making metal available or keeping it parked. Watch physical premiums for common products and key wholesale forms because the physical market often speaks in availability and terms, not just in headline price. Now zoom out to the human part because this is where the divide forms. Some people experience markets as narratives. They wait for an explanation and then react. They look for the single reason something moved. They assume the story caused the price. In calm periods, that approach feels safe because markets move slowly enough that stories seem to fit. Other people experience markets as structure. They track constraints, collateral flows, and inventory optics. They understand that the biggest moves often begin with a mechanical shift. Financing gets tighter, liquidity gets thinner, and forced participants hit the same exit. It's not about being smarter, it's about paying attention to the right layer, because the wealth gap in markets is often an information gap. Institutions see the schedule before the headline. They see the margin change, the roll pressure, the index rebalance, the dealer positioning, the risk limits. Retail often sees the chart after the move and the explanation after the chart. That's why events like this feel unfair. It's not that someone always knew the future. It's that someone understood the mechanism that would produce the move once certain inputs changed. If you take one thing from this, let it be this. When precious metals enter a danger zone, it's not the metal that changes first. It's the terms under which exposure can be held. When those terms tighten, price can fall faster than intuition thinks is possible, even if the long-term identity of the asset hasn't vanished. This is signal and structure, where we decode what matters before its headlines. If this connected dots you hadn't seen before, you know what to do. And keep your eyes on the plumbing because the next big move in metals won't start with a speech or a rumor. It will start with a number on a margin schedule, a flow on a calendar, and a gap between paper speed and physical friction that cannot stay open forever.